So many people ask, I need to get, PVG Asset Management. All of our strategies are on that site. You can get a tear sheet. So the PVG performance overview. So we put, this is our best portfolio this year, and I want to highlight it a little bit. We've been talking about this, how we do a good job on picking stocks in the biotechnology sector. Actually, these returns are quite remarkable. So we're up over 900% since 2012. 900%, and the index is up roughly 300%. So we've been doing a really good job of picking stocks. We look for those companies that can have a 5 or 10x upside, and we've been pretty successful on picking these. So just want to highlight some of the performance of our strategies. We had a really decent quarter in the second quarter. This quarter starting off well as well. Our emerging healthcare strategy, that is lightning in a bottle. Okay, that's lightning, and then thunder is right below it. The tactical growth. The tactical growth is it's a great tactical portfolio. It does about a 20% average annual return. This is the benchmark. This is the Morningstar aggressive tactical portfolios that we compete with. You can see we're nicely above our competitors. So really strong performance, and we have the downside protection too. So for an aggressive investor, these two portfolios, maybe do like an 80-20. This over time, give me 5 or 10 years, and you're going to have, hopefully, if everything goes well, if the world doesn't come to an end, right? Everything goes well. We don't have a depression. These portfolios should be really nice returns, compounders for us. Dynamic core. Okay, this is a more conservative strategy. It's Morningstar peers. We're beating that quite a bit. This is just the S&P 500, and we risk manage it. And then our tactical total return against its similar benchmark. That's probably our most conservative strategy besides our loss-averse equity income portfolio. But let me show you some of the performance. So tactical growth, you can see average annual return almost 20%, beta of 0.83. So we're getting really nice returns, but it's below the market beta itself. Dynamic core, this is the S&P tactical portfolio, 8.5. But look at the beta, 0.35. So any investor could own this. So this is a nice portfolio. It gets good returns, and it's got really good risk management associated with it, along with tactical total return. Again, 0.34 beta. You can see these betas are quite interesting. Emerging healthcare, big returns. The aggressive, moderate, conservative, and income and absolute return, these are kind of set allocations. So aggressive is 80-20, but then we modify the 80-20 mix as we see it being appropriate to do so. Again, a little bit of aggressive portfolio, beta 0.66, almost a 16% return, moderate, kind of consistent with those returns, all the way down to income. Income, we got nice returns. Actually, we think our returns are going to be higher now, given that the level of interest rates are much higher since we started this strategy. But interest rates are higher, we can get nicer returns. Those baby bonds yielding 8% are really attractive, and you got a nice low beta. So I wanted to walk you through our philosophy, why we're loss averse. It's so important to understand this. These numbers are going to blow you away. So this is a cartoon depiction of our dynamic core strategy. So the S&P 500. We're the black line, right? The green is the S&P 500. And then when, say, for instance, this is 2008. When we break the 200-day moving average, we're locked down. We got it hedged, right? And so as you go through this cycle, the market falls quite a bit, like it fell about 40%, and then, hopefully, which we did, we're going sideways. So we're going sideways through this period. Actually, the Dynamic Core was off about 5% in 2008. And as you know, the S&P 500 was down close to 40% that year. So we're going sideways in a downward falling, bear market. And then we reinvest as we start to come out of it. And these are not levered numbers. This is just compounding of money as the markets go up. Now we're at a top, somewhere around the top of the markets currently. Maybe extends for a couple more years, but maybe we roll over too. So we could easily see a 5 or 10% pullback in August, September. Such good news in the overall markets, but we have some probably sentiment to still run the markets a little bit anyway. But what we could see is this pullback. We want to keep these gains, right? If we had perfect timing, okay? Barron's thinks I have perfect timing. They wrote an article about this, years ago, and I'll show you some of the quotes. But if we had perfect timing, so you can see here, this is from 1996. Big up move, back down. So you lost everything you gained from 96 and bottomed out in 2002. You lost everything you gained. So if you had perfect timing, you're out here, you're in here, you're out here, you're back in here. That's what we want to do, okay? In here, out there, okay, and then back in here. So there's not that many trades here over a very long period of time. So if you had $1 million and you invested it in 1996, your portfolio would have been about $5 million. And this is as of September 30th, 2023, okay? If you had perfect timing, okay, this is the beauty of not going down and compounding money. You would have had $61 million. Crazy, huh? Well, that's what we want to do. So you can see this tactical growth portfolio. If you grow at 20% a year, you're going to have these type of returns. So, as long as we can hedge that portfolio when the market drops, we're going to get really big returns. So our philosophy is to protect the downside during bear markets, but also get really good returns when the market's going up. We provide separately managed accounts to investors or UMAs, United Managed Accounts to advisors. And so an individual could get these type of portfolios through their investment advisor. Now, if you're an individual and you want to come us to directly, you can do that as well, as long as we're not competing with some of the investment advisors that we work with. But so we provide separately managed accounts for institutional investors, financial advisors, and individuals. So our tactical strategies, they're different. They're different from the typical tactical manager. Our goal is to protect the portfolio, not to be aggressive all the time, but to protect that portfolio and to be proactive, not reactive. So start to do it earlier rather than reacting to roughly right now an 8 to 10% drop in the overall market before you do anything. So making money in rising markets, most every manager can do that, right? It's not hard. Every individual can do that as well. But protecting your portfolios during declining markets, we think we did that really well. So we have the combination of the two. Just remember, we hate to lose money. So that's the most important thing, is to not lose your money and allow that money to compound over time. Those positive returns compounding over time. Even if we're going to get a 5%, that's a lot better than being down 5%. So as those things compound over time, never get a 40% decline. So we really want to avoid those major declines in the overall stock market. Compound positive returns over time gets you really nice returns without risk, a lot of risk, I should say. So we don't like taking unnecessary risk. You don't have to do that. So we have 6 portfolio managers. 4 of us work on the GIPS composites, meaning the strategies I just showed you. There's 4 portfolio managers on those. GIPS means it's a verification you get by an auditing firm annually. It's called Global Investment Performance Standards. It's really important. If you're going to hire a money manager, make sure they are GIPS verified. So the returns that we show you, they're real returns. Okay, lastly, that's me. A little bit of background of me. I have my MBA like probably everybody else, and a CFA, and graduated from the Ohio State University in finance and accounting. In my work experience, I worked for some of the larger mutual fund companies managing their flagship portfolios. My last job was with the Burger Funds prior to coming to PVG and buying PVG. But I was at the Burger Funds for several years, having great performance. And then prior to that, I was at Kemper in Chicago, managed their flagship portfolio. And then I was at Founders Dreyfus, also in Denver, like Burger, and had one of the best performing balanced funds. So risk managed, right? Had one of the best balanced funds for 3 years running. I was the top balanced fund manager. So Barron's coined the phrase that I had all the right moves in an article and perfect timing. I wish I had perfect timing. We have good timing, but not perfect. I think hopefully you found this helpful. If you have any questions, just reach out to us. We'd love to set up a call and see if these portfolios fit your risk profile. Thank you very much.